I'm Rob Freeman with REALTOR Magazine, and I'm with Victoria Gillespie, who is the Director of Business Development for Realtors Federal Credit Union, a division of Northwest Federal Credit Union. And last month, Victoria sat down with the magazine for the first segment of our video series called Your Money Matters, and she talked about why it's important for real estate professionals to set aside 30% of every commission check so that when tax time comes around, there are no surprises. So this month, Victoria, I thought we would build on that conversation. And let me start with the question, in addition to the 30% that real estate professionals should set aside for taxes, what other steps can they take to smooth out their income stream?
It's a good question. I would think the next thing that comes to mind logically would be to prepare for reserve funds. We know that the 30% is one of the most significant, but second in line would be that 20% of building a reserve fund. I use the 20% here at the credit union as a rule of thumb that we want to start to aggregate a pool of money that we call reserve that is going to be available for anything that could come up. A canceled settlement, an emergency at the home, a vehicle problem. This reserve fund should be kept fully liquid to the realtor. And when I say liquid, I mean there should be no penalty for withdrawal. It should earn interest, and it should be easily accessible should they need to.
It sounds like what you're saying is for every time a real estate professional gets a commission check, that person should take 30% out for taxes, an additional 20% out for this short-term liquid reserve fund.
I know that seems like a dramatic number, but I think it's important that people see it as that, because so many times they see a large amount on a commission check. The 30% of taxes, the government is going to take that, so that's spent. Whether you're planned for it or not, that will be gone. And the 20% is to build that so that you are not needing to rely on that next commission to survive on daily living. Rob, I would like to make a point about the 30% that draws on our last session. We talked about how important it was to have a tax advisor. Some will and some will not, okay? If you have a tax advisor, that tax advisor is going to calculate what's called quarterly withholdings. They're going to prepare in prepaying some taxes in a quarterly withholding for that year-end tax bite. If you are not having an accountant do those withholdings, you then want to opt for 30% in this bucket that we talked about. It is not both in total. You do one or the other. So if you have the tax advisor, they're going to do tax withholdings quarterly. If you don't, you should be allocating 30% in taxes, and I just wanted to emphasize that.
All right, so you mentioned the reserve account. You want it to be liquid, meaning there's no penalty for a withdrawal.
Correct.
So let's talk a little bit more detail about some of the options that practitioners have available to them in the different types of accounts that they might, choose to put their money into.
I guess for a basic starting point for any realtor, here at Realtors Federal Credit Union, I would suggest a basic savings account. Not a lot of glitz to it, but what it is it's a product that's going to allow you to start getting earnings, accumulate that reserve bucket, and have access to it should you need it. I keep using that term liquid because that means you can get to it without penalty anytime you need it for living expenses. However, you're not imposed a fee to do it. So I would suggest start out with the basic savings. $5 investment to become a member here at Realtors Federal Credit Union. And that's not a fee or a charge. It is what you do to enroll as a member for a lifetime membership with us. As you start to accumulate more than a minimal amount, we could then look at higher balance requirements such as money markets that would yield a little more. And even when you go further and you've really built that 6-month reserve, we could look at short-term CDs, certificates of deposit, which offer even higher rates. But remember, when we're going into a certificate of deposit, that is no longer a liquid fund, meaning that if you take the money out during the term, you will be imposed some form of a penalty.
Well, just take a minute and talk a little bit about, now I know we're in the rate environment today, because of the nature of, because interest rates are so low, the kind of return that you can get on even a very prudent account won't necessarily be that high because that is the environment that we're in. But can you just talk a minute about the kind of rate that you could get in, for example, one of these savings accounts compared to some other options that are available?
Sure. Just as you said, it is an ultra-low rate environment. So remember, savings rates are down, but borrowing rates are also down. So there's good in that. Recall that. But I like to give this example. Our basic savings rate here at the credit union is 0.25. Okay, so that's 1/4%. Doesn't sound like a wow. However, we go out and we shop traditional banks. Right now, a basic savings rate, the low minimum balance at a traditional bank is about 0.05. So if you compare that, a traditional bank, 0.05, Realtors Federal Credit Union, 0.25, that's 5 times greater. Now, when I say to you 0.25, nobody's wowed by that, but what I will tell you is as the rate environment improves, we'll watch those spreads and those multiples continue to improve. So inherently, a credit union will always pay you higher than a traditional bank.